You've probably heard of all these horror stories of people losing their retirement funds and fortunes during economic recession. And I myself have heard of people jumping off buildings and committing suicide in places like Hong Kong because people had way too much property and they couldn't pay the mortgage and the interest off, and so they rather just end their life. This is a sad reality when it comes to the stock market. Fortunes are made and lost in this volatile game, and however, it's just really easy to lose money and not realize gains. And so in this episode, we're going to be talking about why you would lose in the stock market and how to prevent that from happening. So my first point is loss aversion. If you've never heard of this concept, then just think of this question. Would you rather find $10 on the floor, or would you rather accidentally lose $10? Loss aversion is the psychological effect that we're twice more likely to be emotionally affected by losses compared to by gains. With this in mind, we basically just don't like to lose. And in my personal experience, I tend to find that I let losers continue to lose while I like to sell profitable trades way too quickly. And this is because if we're in a position, we don't want to lose any of those gains. But however, if we're in the red, and we want to wait and wait until we lose less. However, the problem is we think that we're going to lose less, but we often lose a lot more than we planned. The unfortunate part is that because of loss aversion, we are emotionally charged to miss out on profits and to hold on to shares that just keep going lower and lower and hoping that the trend would change and go our way. So when we look at our long-term trading or investing career, our losses will outweigh our gains because we tend to be more patient with our losses than with our winners. So this leads to our second point, is that fear of losing and also fear of missing out. Have you ever held on to a stock that just kept going down and down and down, and you hit your breaking point and you're forced to sell at a tremendous loss? And the funny thing is that usually it turns around right after you sell. And don't you think that the market is out to get you? On the flip side though, have you seen a stock that just kept going up and up and up, and you're hearing everybody who's in the stock making a fortune, but you're sitting on the outside watching all your friends buy Ferraris, and you don't want to miss out, so you put all your money into the stock, and for God's sake, for something like Dogecoin. Remember in December of 2017, Bitcoin was at $19,000 USD, and somebody bought it at that price. Even though now Bitcoin is still over $10,000, think of the losses that person took and is still taking if they haven't sold it yet. We don't know if Bitcoin's going to keep going higher and higher, but that person holding those Bitcoins right now must feel pretty horrible. The point is that the stock market will usually always recover. It's just a matter of time, of how long it takes, and if you can last that long paying off all your debts. But if you're being emotional and selling at the low and buying at the highs, then you're doing the exact opposite of how to make money, so welcome to losing. My third point is for people playing on margin and they're overextending themselves. As mentioned, if you just hold on to your shares and buy more at a lower price, then likely it'll come back up over time. However, some people overextend themselves by borrowing more money and putting it into the stock market. The concept is this. Let's say I'm borrowing money at 2% interest, and then you're making about 5% return on your investment. Then you'll be making the meat in the middle, which is 3%. But let's say the market is tanking and you're losing 5% in the market, and you're also paying 2% interest on top of that, then that's how you lose your pants. See, if you just use your own money to invest, then you only lose back to $0. But if you're borrowing money to invest, then you'll end up with $0 and also owing a great deal of debt to other people as well. In the end, it boils down to one thing, and that we're human and we are emotional. And we fear loss, we are greedy for more money, we regret missing out, and we always hope for things to turn around. And if you want to learn more about these emotions, I have a full video right here about the 4 emotional sins of trading. It'll give you ways to avoid getting emotional and just letting that affect your investments. And in the comments below, let me know if you are winning or losing in your investments. And if you enjoy this video, make sure you hit that like button, subscribe to my channel, and we'll see you guys in the next video.